Today, Bitcoin tumbles following a weekend rally. The DOJ accuses Sam Bankman-Fried of potential witness tampering, and S&P Global lays out the future for tokenized stocks and bonds. Welcome to CNBC's Crypto World. I'm Kate Rooney. Right on the heels of a weekend rally, digital currencies are starting the week with a sell-off. By noon Eastern, Bitcoin fell by 2.5%. Ether dropped by more than 3.5%, while Solana tanked more than 7%. Let's talk about some of the top stories. First, Sam Bankman-Fried is denying claims of witness tampering. Prosecutors claimed last week that SBF tried to reach out to the General Counsel of FTX US on Signal. The alleged message said that SBF would, quote, love to reconnect for a constructive relationship and to potentially, quote, use each other as resources when possible, or at least vet things with each other. The DOJ argues these messages show efforts to influence witness testimony. Well, on Saturday, Bankman-Fried's lawyer responded, insisting that the former CEO wasn't trying to witness tamper, but actually trying to help with the FTX bankruptcy. Prosecutors want to tighten the restrictions on SBF's bail, including a ban on encrypted messaging apps or contacting FTX staff. Next, troubled crypto exchange Gemini reportedly told Earn customers their funds were safe during the crypto meltdown, even though they weren't. Axios reports that Gemini didn't explicitly say its Earn program was federally insured. Instead, it said the GUSD stablecoin was backed by dollars that could be held in FDIC-eligible accounts at State Street, Signature, and Silvergate banks, leading to many customers believing that their funds were protected. The former senior attorney of the FDIC told Axios the practice was, quote, skeezy, but couldn't be sure if it was illegal. It's a crime to imply that an insured product is FDIC insured, and last August, the FDIC issued a cease and desist to several crypto companies making false claims about their customer protections, but Gemini wasn't on that list. And last up, Premier League just inked a deal for NFT player cards. The soccer league just signed a multi-year deal with So Rare. That's a fantasy soccer game valued at $4.3 billion. So Rare has about 3 million users worldwide, and they'll be able to purchase and use officially licensed NFTs. Sky News reports the deal is worth about $37 million, and it comes despite a slump in NFT prices and trading activity. The average price of NFTs fell 63% between December 2021 and December 2022. All right, keeping with NFTs for our main story, S&P Global is out with a new report on the future of tokenization, and it sees a world where stocks, bonds, art, and more can all be tracked on-chain. S&P also says we won't get there overnight. Crypto World's Jordan Smith spoke to the firm's chief analytical officer about the report and the biggest hurdles to a tokenized future.
So S&P Global just dropped this new report on a tokenized future, and I think the overarching theme for this report is that digitization of tokens is the future of financial markets in one form or another. Can you walk us through this change that you guys see coming in this report? I think calls it a revolution. When did this shift begin?
We put out a magazine called Look Forward across S&P Global, looking at some of the key trends we identified that we think will disrupt the world by 2030. And we picked tokenization among 10 other topics, including geopolitics and the end of law for longer, etc. And we do think that tokenization has the potential to upend how financial markets function. And what we mean by tokenization, we really mean the conversion of assets and rights into a digital representation, i.e. a digital token on a blockchain. So, and then this token can be owned, used, and transferred through a blockchain, reducing really the need for certain third-party intermediaries, and therefore it could really enhance efficiency, accessibility. These are two of its main promises. And we also touched in the article on the technological and regulatory hurdles that mean that it won't be an overnight revolution, and it might not be as decentralized as some people might think.
What would drive financial systems to switch to this technology as it's becoming more popular?
The main attraction is threefold. So one is the accessibility and liquidity. So tokenization allows fractionalization, i.e. by that we mean that investors can purchase tokens that represent a very small share of the underlying asset. So I'm thinking, I don't know, if you could tokenize Mona Lisa and own millions of Mona Lisa, that would be something very novel. So opening a new access to new markets. I mean, there would be more serious examples, potentially in the real estate sector, for instance, that we could think of. And therefore, it could democratize direct investments in more costly assets and boost access as well to underserved segments. So that's one element. The second attraction really is around efficiency. So the technology, but also the smart contracts that can be used could really allow a faster and a less costly asset transfer. And by that I mean it would really automate certain function process, especially if you think of post-trade steps such as clearing and settlements, and therefore reduce the need for certain intermediaries. And then finally, this question of transparency. It's an immutable ledger that can be tampered with, and also it could allow acquirer to know who they are dealing with, what are the rights and obligations that are attached to a particular token, even who the previous owners were, etc. So I think this traceability as well could be interesting and very attractive if you think maybe of supply chain management as an example.
You mentioned fractionalized ownership of the Mona Lisa and things like fractionalized ownership of art. How do you expect sentiment for these products to change? Is this something that businesses are going to have to adopt to get people on board before we reach this revolution that you talk about?
I think fractionalization is an interesting aspect. I think there may be an element that might have been oversold about the benefits of tokenization. Fractionalization is not necessarily for everything. I mean, not every retail investor might be eligible or should be deemed eligible to invest in certain asset classes. I think customer protection should be paramount as well. And I think that's why regulations will have a key role to play. Also, fractionalization comes with its own risks or problems. What's the governance if you split the ownership of office block across 1,000 retail investors? You still need a governance around that. You still need a way to make decisions. And therefore, I think fractionalization hasn't yet been really happening overnight. And I think there are good reasons behind that, because there's a lot more that needs to be thought through. And I think there's also a lot that regulators will want to be considering.
What is the regulatory gap that this technology faces before it goes mainstream? I
think they go even beyond regulations, whether there's a good regulatory environment or not. I think cryptocurrencies are probably the best known, the much publicized form of token. But cryptocurrencies are not an end in themselves. In a way, they're not. There should be a means to an end, really, rather than an end in themselves. The purpose, the service, really, if you have a means of exchange on the blockchain, this underlying technology that really enables you to, for instance, finance real world assets in a more effective way, or open the access to other investors. I think the media is very much focused. Often by the price of Bitcoin or Ether, but a better measure of the success of the blockchain technology would be to look at the volume of real-world assets that are financed through the blockchain, or what's the amount of remittance that's cross borders and on the basis of a blockchain technology. I think these are much more interesting aspects, and I think that's why I see where some of these comments are coming from. What's interesting is more the underlying technology. Maybe cryptocurrencies have taken just too much of the limelight, but what's interesting is more what the technology under this would enable.
A guest I spoke to earlier this week for the show said, in his opinion, that there's really no interest for the blockchain technology without crypto itself, but it seems like this report is making the opposite argument, that there is an underlying use case for these technologies that financial systems or companies can use, regardless of what's happening with the price of crypto. Is that what you're seeing when these companies are adopting this technology, that it isn't really about cryptocurrencies, it's more about the technology that makes crypto happen that can be used in other use cases?
Correct. I think one trend, if we see probably a trend for the next few years, That's until now a lot of focus on cryptocurrencies, what's the price and the volatility of Ether or Bitcoin. I think now what we'll see more and more is focus and articles looking at what the technology enables in the real world. So when we talk about DeFi, until now it's been very much borrowing collateralized by one crypto asset to buy another crypto asset. That's very inward looking, or almost like navel gazing. What's more interesting is if we start seeing DeFi platform enabling the acquisition of real estate, or enabling the financing of trade finance in some emerging markets, or supply chain finance in some emerging markets. That probably would be the next trend we would expect to see.
All right, that's it for Crypto World today, but we'll be back again tomorrow with a lot more. We'll see you then.